Good afternoon. I'm Pence, and it is Friday, October the 29th, 2021, about 3:30 in the afternoon. I'm going to take a few minutes here to talk about what we see going on in the world. We'll talk a moment about the markets, inflation, the economy, the virus, some of the policy things that are going on, and then, so what does it all mean? If you think about where we are in the S&P 500, we've gone through a period of time of exceptional growth. And then we've had things back off a little bit, and then we've reaccelerated. Now, a lot of this has been, following the trends and ideas around COVID. But the big thing that's a fundamental driver of economic activity and the markets today is the fact that due to COVID, we have pumped over $5.4 trillion into the economy in 1 year. That's a very, very big number. That's 25% of 2019 nominal GDP. But we basically have, with all the stimulus that we put in response to COVID, we put in more money in 1 year than we did in all 4 years that we were involved in World War II. That is tremendous. And this amount of stimulus that we've pumped into the economy in such a short period of time has created a whole series of consequences, some of them very intended, right? We kept things going, some of them unintended. We now have this very violent set of numbers because we've never been here before. We've never done this before. So when people think about what is the next normal, because we're all trying to get back to some version of normal, well, the next normal is abnormal. We think it's going to be abnormal circumstances probably throughout 2023, 2024, until it'll be 2024 before things make sense. I mean, we've never been here before. Think about it. We've never had a round trip in the market of 126 trading days. Remember, the market fell very, very rapidly and then grew back very, very fast to get back to even. That's the shortest period in history. We've never had a period of time where we lost so many jobs, right? So many jobs in such a short period of time. 22.4 million jobs, and then we recovered in 18 months. We've recovered over 17.4 million. This never happened before. We lost 15 million jobs in the Great Depression. But it's very important to recognize just how strange all the numerical comparisons are going to be. We've never been here before. We've never had a circumstance, if you can take a look at initial jobless claims, where it's spiked up as high as it did and then came back down. So we're in this environment where most of the numerical statistical comparisons that we make from year to year, that we base economic decisions upon, are all bouncing off of very abnormal levels. So you really can't fully trust or make sense of them. And then now we also get into an understanding of the rest of the consequences of what about inflation. Now let's talk about inflation here. The big issues around inflation are scarcity and abundance. What happens, right? When there's not enough of something, the price goes up. When there's too much of something, kind of the price goes down. Scarcity in commodities and abundance in money. I'll just remind you kind of your Econ 101, right? This is a downward sloping demand curve, upward sloping supply curve. There's a price equilibrium. But if you cut supply, prices go up. That's what we've seen with some of this backlog and stuff. And when you increase money, right? When you increase money supply, demand goes up. So we have these situations where we have an abundance of money and fixed supply, and we're looking at inflation moving prices up. And the big question that people have is this transitory? In other words, once the supply chain cleans itself up, it'll go back down, or is it permanent? And we're seeing a continued rise in prices over time. We think the answer to that is yes. It's transitory for a while, so inflation will go up for a while, and then we think it'll kind of go back down, but then won't be back down to where we were before. And indeed, we spend a lot of time talking about the supply chain. We spend a lot of time at the investment team tracking. I mean, it talks about shipping problems and stuff. We actually track many of the ships all over the country and all over the world. These are the ships in the global supply chain. And you can see this from a satellite view almost daily. And we see the big problems that we see in the bottlenecks at the LA Long Beach harbor. And that's important because about 45% of the commerce of international comes through that harbor. So it's very important to understand, why are there bottlenecks? What are the choke points? What's affecting things there? So to give you an idea, right? So one of the problems that we talk about is we looked at this bottleneck at the supply chain, right? Remember, if the supply chain's constricted, that's shorter supply, prices will move up, right? That's what they're talking about when they say transitory. So then we said, well, why is that? What are the components around that? I mean, there's obviously a ton of ships and a lot of containers, but why can't we get it out of the port? Well, part of the problem is truck drivers, right? We shut down all the schools in response to COVID, where we trained our truck drivers. You had a bunch of people retire. There's no schools training new ones, so immediately you have a shortage. This is a regulated industry in terms of, it's not anybody can go drive a big 18-wheel truck. You have to get permits, you have to get licensed, you have to get training. So basically, when we look at the choke point, as we always talk about these things, what's the scarcity? Well, there's a couple of things, right? The first one is truck drivers. So we've got to get a lot more truck drivers on the road. And basically, we're short, right? The shortage we're probably 80,000 truck drivers short of what we need just to move transportation around the country. Now, those of you who have known us for a long time know that I always look at pieces of every supply chain to try to give us an idea of what's going on in the economy. You've heard me talk about in the past, when I want to see what's going on in the industrial economy, I take a look at pallet manufacturers, right? If pallet manufacturers are really, really busy, it's because industrial manufacturers are ordering pallets, because you can't ship something unless it's on a pallet, right? So if the pallet manufacturers are really busy, that means that the factories have basically started ordering a lot of pallets. That means they're making a lot of stuff. So it's a precursor. It gives you an idea of what's going on in the future when we look at manufacturing. So we kind of take that same analysis, right? And we look at chassis. I mean, this is kind of crazy, you might think about, but what is the biggest shortage right now that they're having at these ports? Believe it or not, it's these chassis. They don't have the chassis to move the containers around to get them from the ship out to the loading area where they can get on the road or on the train. Now, this is an example, unfortunately, why are we short of chassis? Well, there's moments where policy kind of collides. And so long about last May, the administration put a tariff on truck chassis, 220%. For imported truck chassis. So we stopped getting truck chassis from overseas because there's a big tariff on them back in May. And well, here we are in October, and we have a massive shortage of truck chassis, and no one can buy them or get them, or they're very, very expensive. So this shortage has turned into a real big problem at the port of LA and Long Beach. So here's an example where an unintended consequence of a particular policy has created kind of a real big problem elsewhere. Maybe they'll get that fixed, but in the meantime, we have a massive shortage of chassis. So if you want to think about and you're talking to your friends about, golly, what's the supply chain problem? Well, let's look at the real shortage of the thing that has multiple consequences. And in short, it's a truck driver and a chassis. So if you know people that are looking for jobs, they need to probably think about that. Now, moving on. So what's happened are boxes, or the average period of time that these containers are waiting, has moved up because they can't clear out the ports fast enough. And not only that, you're beginning to see that Southern California's share of ports in the mainland has fallen. Why? Because the backup is so deep. You've got hundreds of ships backed up there waiting for a berth, waiting to unload. And by the way, folks, it's just very simple. Christmas is on the ship, and it's probably not going to get loaded in time. It's not going to get unloaded in time. So do your Christmas shopping now. And what we're going to see about retail going forward is during the Christmas holidays, as we come up, the whole holiday season, it's going to stop from being, stores asking you, well, what would you like to buy? To consumers are going to walk into the stores or look online, and their question is going to be, well, gee, what have you got that can get here on time? So the shopping environment is going to change dramatically. And I recommend, if you haven't done your holiday shopping by now, you better get on it, because there's going to be severe shortages. Now, Let's talk about inflation. Again, this inflation issue, as I brought up, a lot of it is transitory. These supplies, you can't take a global supply chain that was operating at maximum efficiency in a global just-in-time thing, shut it down completely because of COVID, and expect it to start back up. We took 20 years to get an efficient supply chain. We shut it down immediately. It's going to take a while. We think it's probably now going to be about a year before this stuff straightens itself out. What does that mean? Well, you're going to see higher inflation throughout due to this transitory nature for at least a year. That's going to be the supply chain disruption. And then all the money working through the economy as a general rise in prices, a general catch up in these things, that's going to continue to be there. So what you have to recognize, though, is that the Fed has been trying to get a 2% inflation rate for a number of years, and they really haven't been able to get it very often. So now they're finally getting what they want. Maybe this is a little bit of a gift, but when you think about it, we could have a 3% inflation rate for almost 5 years before we get the overall long-term rate back to where the Fed wants to be. The reason why I bring this up is that people worry about inflation because they're worried about the Federal Reserve raising interest rates, which could increase the cost of everything. My point is I think the Federal Reserve is going to be more tolerant of this inflation that we're seeing in the economy right now and be a little reticent to raise interest rates too much. They're going to raise it some, but too much in response because they think over time this is going to level itself out. And what they really want is at least a 3% interest rate for a couple of years anyway. So we're beginning to see all of the price increases, and what we look at is real personal consumption, right? We always say we focus on the consumer, see what they're doing. Nobody makes a penny until someone decides to buy. So when we look at what the average person is seeing, they are seeing an increase in prices all along. Pretty much everything that they do has really gone up in fuel and housing and stuff like that. And some of those price increases are going to be with us for a little while. But from an investor standpoint, what we want to focus on is what are the companies that can maintain margin when there's a price increase. So we're going to have a little inflation. We may have a little higher interest rates. Neither of these things we think at this point are recessionary. What it means is for an investor is you want to kind of make sure that we're looking company by company, step by step, on the ground research to find the companies that are able to raise their prices in this environment and either increase or maintain their profit margin. Now, as we look to things that are going to affect people's behavior, one of the things to pay close attention to is the share of income needed to cover housing costs. We're seeing that tick up a little bit. Housing prices have gone up. Demand's gone up. You've seen people move out of the coastal areas into the more suburban areas. All of the housing demand's gone up, and we're beginning to see that happen. So the important thing to pay close attention to is when we begin to see housing costs get higher than 33 to 35%. That's where it gives us some real concern. So we're watching this very, very closely, and we're going to keep an eye on it. Most of the things I'm talking about today are stuff that we're just kind of, here's what you need to look out for. Here's what we're watching very carefully. As we navigate this environment between now and 12 to 18 months from now, when we begin to see the supply chains kind of straighten themselves out. Now, what does all this mean for the markets? Well, when you put $5.4 trillion into the economy, that's a lot. That's a 25% boost all at once. Lots of liquidity, lots of money. You're going to see demand go up. And indeed, it's going to show up in all of the companies, the S&P 500. When you take a look, about half of them have reported. And basically of those, most of them are beating on sales. Most of them are beating on earnings. And so we're looking at the fact that human beings, consumers in the United States who are masters at consuming things, we've adapted. We've figured out how to go out and buy the things we want to buy, and in many cases do many of the things we want to do, even in this COVID environment, even in this environment where we're still trying to adjust with all these things going on. So people adapt. We are the most adaptive species on the planet, and it's certainly showing up. And you can see it in companies that are be able to beat on sales and beat on earnings estimates, even in this environment. And indeed, when you look at profit margins of the S&P 500, they are record-breaking. People go, oh my gosh, the stock market's at an all-time high. Well, of course it is. Earnings are at an all-time high. remember when I talk about this, we say we really want to focus on the earnings of companies. And if the earnings of a company are at an all-time high, it would make a little sense that its stock would be at an all-time high too. So we look in this environment, as we look out over the next year, year and a half, things are going to be bumpy, right? Not everybody understands. It's going to be abnormal, both in market prices and also in consumer demand, because some sectors are going to have a clearing supply chain and get back to normal faster than others. That's just the nature of this. So as we look at the markets, we've got to recognize S&P 500 companies, they're having blowout profits. I mean, they're basically beginning to look at these profit margins that have come back and fully recovered, and that profit margin looks good. And we see the market bouncing around. This is the range fan. Those of you who have followed us for a long time recognize we publish this every year, have for probably 2 decades. And this is our statistical analysis of probabilities, where the S&P 500 is going to be based on earnings estimates, right? So if the market gets a little ahead of itself, you can see it comes back down, and we kind of moves around all within this trend line. So if you ask me what the market's going to do, it's probably going to end up in the year somewhere along this range fan. But we're going to have some volatility getting there. It's going to swing back and forth. So we have to be prepared to take advantage of that. Like I always say, take advantage of volatility. Don't be its victim. So we want to focus on that. We want to have a little dry powder when we get these downward movements in the market. It's usually a pretty good opportunity to buy things that you've been waiting to buy that you might have thought were a little overpriced, because the underlying fundamentals of the economy are still quite strong, and there's a tremendous amount of liquidity, a tremendous amount of pent-up demand. Now let's talk about the thing that's going to create some more volatility. In addition to supply chains concerns that will straighten themselves out over time, longer than everybody thought, right? We're looking at a year's worth of supply chain problems here before it all gets back to normal. At least that period of time. Some sectors will get better, some are going to take longer. But then the next thing is, let's take a look at the virus. The virus is the thing where we hit wave after wave. And this is the way this is going to happen going forward. The virus is going to continue to hit us in waves. There's not going to be we don't believe that there's going to be a moment where the virus is completely gone. We're probably not going to eradicate it. It's going to become endemic. It'll come back every year, maybe twice a year, and we're going to have to adapt to it. But we seem to be able to do that as a society. So you see these hospitalizations, again, it all comes in waves. And you can look at hospitalizations by age, and you're beginning to see these waves of younger people affecting and working their way through. So it's important to recognize that COVID is probably not going away, right? It's just going to be one of these things that works its way through year after year after year. People are going to get vaccinated. People are not going to get vaccinated. People are going to get it. People are not going to get it. But the important issue is how we adapt and go forward. And you can see in the United States, cases are going down a little bit. We're working our way through the last wave. In Europe, they're having a tougher problem with this than we are. A lot of it depends on what drugs you're using. A lot of it depends on how the society is functioning and the amount of density and how quickly they've gone back to work or locked down. So we're beginning to see, again, this global recovery or global management of the virus is different from country to country. And indeed, the United States seems to be handling it better than most. Now let's look at the economy. What does all of this mean? And the economy is the underpinning for the markets and everything else. I want to give you some perspective. When you look at the number of employees, right, we had this moment where we shut everything down. We had a very quick recession, very rapid recovery. And the point of the matter is we now have more people back working, right, than we did at the end of the Obama administration. So the important thing is we've kind of done this round trip. We're not back to where we were pre-pandemic peak, but we're back pretty darn good. And that's important. And as an economist, I always say that it's probably more important to look at the employment number than the unemployment number, right? We want to look at how many people are employed because they're actually doing more activity in the economy from a growth standpoint. So I always try to focus on that number. Unemployment's very important. You have to pay attention to it. It's a big public policy issue. But I also want to see how many people are working and how much money are they making. So the next thing we have to look at is you have all employees, non-farm in the millions. And then you have to recognize that the recovery has still been a little uneven, right? Higher wage people, middle wage mid-wage people are now pretty much fully recovered, but unemployment for low-wage workers is still below pre-pandemic levels. And then we look at continuing claims for all programs, you're seeing that drop off very, very rapidly as the economy is recovered. Now, one of these issues that's here that I want you to pay attention to over the next couple of months is this. For many, many low-wage earners, they basically made more money being unemployed than they did when they were working. Due to all the benefits and the supplements that were there, them staying unemployed was better, and they made more money, right, than they did when they were working. So there was not a lot of incentive to going back. And in addition to that, there's a tremendous amount of savings in the business. There's a tremendous amount of savings that have been pent up in the market. So people have reserves. And so you had a bunch of states that ended unemployment benefits early and a bunch of states that didn't. And at first, you're saying that, wow, when we did this, we ended this stuff in July, August, September. The rest of them ended in August and September. And some states ended in May. But why didn't we see this great big jump? Okay, why didn't we see this great big jump in employment when the states ended some of these excess benefits early? Well, the first one is folks had a lot of savings. And low-wage earners who really didn't like their job to begin with had saved up enough money that they can continue to not work, even though they're getting lower unemployment benefits. They can continue to not work for a while longer. So they're not in a hurry to go back to work to a job they don't like. The other thing that happened here is retirements went way up. People have taken themselves out of the labor force. Basically, if you were near retirement in 2020, you got put on unemployment, and we saw this happen back in the last crisis in 08 and 09. What happens is basically people get on unemployment, and they get 99 weeks of unemployment, and then their unemployment benefit's just about the same as their Social Security benefit. So what they've actually done is they just retire two years earlier, right? So you're seeing as a lot of people, the normal trend was the red line. This black line has increased, and so the retirees have increased vis-a-vis what one would normally expect. And basically labor force participation in those 55 older has gone down. So again, you saw people just leave the labor force, right, due to COVID. They got laid off anyway. And they're just like, yeah, okay, I'm just going to go ahead and retire now. So what you have is one thing is you have labor shortages for economic reasons. At the low wage level and younger people level, they've saved up a lot of money. They were doing better not working than they were working, so there's not a lot of incentive for them to go back. And so until they absolutely have to go back for economic reasons, they're not going to. So we're going to have a shortage there. In older people, the more experienced workers in skilled labor area, then what you're going to see, those folks are going like, you know, I sort of got used to not working. I might as well just go ahead and retire now. So what you're happening, if two ends of that employment spectrum is creating real labor shortages out there. Now, what happens when there's a shortage of something? The price goes up. So we're beginning to see increase in wages. And it'll be interesting to see where is that crossover point where people find that they're now making enough money in wages that it's an incentive for them to go back. Let's talk further about policy. You hear a lot about the Build Back Better framework. You hear a lot about policy that they're trying to come with a whole new stimulus plan of additional stimulus to put into the economy. Now, we're going to do here in a couple of weeks, probably when they actually have a law passed, we'll do another one of these where we'll walk you through each provision of it. So there's things that are in it now, there's things that are not. So this is kind of what's likely in it, what's likely out in the policy. So we're going to see an increase in taxes, not as high as some of the proponents want to have. We're going to probably not see a billionaire's tax or IS bank accounting reporting, some of the other things that people were wanting. And I'm not going to spend a lot of time on this because we're going to wait to see what the actual bill looks like. But all of these are policy issues that we have to pay close attention to. And we have to be a little worried about dumping another $1 trillion into the economy for certain things. Now, we do believe very strongly that we need some infrastructure improvements and infrastructure reform, but all of the other things may be pouring a lot of inflation on top of already what may be a little bit of an inflationary focus come from just too much money in the economy, right? So I've talked about the markets, inflation, the economy, the virus, and policies, but what is this so what? What does all this really mean? So let me bring it home for you. The markets, we think they're going to be volatile but positive. We're going to see between now and probably the next 6 months, the market's kind of generally trend up, but it's going to be volatile, right? Some sectors are going to do well, some are not. Anytime there's a negative headline, there's going to be a big reaction to it and things will have to grow back up. So just be prepared for this headline volatility to continue to work through the market. But in general, you put $5.4 trillion worth of excess capital in the market, it's probably going to be pretty decent as we go through. So the economy should be reasonably decent with some volatility and constraints, and the market's going to do the same thing. When we look at inflation, it's transitory and it's permanent. Probably inflation is going to go up due to supply chain constraints. That's this transitory part of it. And then as that gets settled down, then basically that inflation is going to settle down sector by sector, but it's not going to go back to where it was because there's just so much money into the economy. So basically we'll kind of peak, we'll fall back off, but it's still going to probably end up being where we got used to no inflation or 2% inflation. You're going to be seeing something into 3 to 4 level. Generally, the economy is strong, but there's sectors that are unstable. That's going to be driven by some of the supply chain disruption and as the system begins to work itself out. The other thing that we need to talk about is the virus. The virus is going to move from epidemic to endemic. I think we're going to continue to see the virus year after year after year. It's not completely going away. On policy, as they try to fix the supply chain, as they try to fix the virus, as they try to fix a lot of things, we have to watch out for unintended consequences. I talked about putting the tariffs on chassis coming into the United States. We ended up with a massive shortage of supply, which has now exacerbated the problems in our ports. And it's going to take a little while for this to straighten itself out. It's created massive disruptions in the supply chain and massive imbalances, right, in what it costs to move things just off the port onto a railhead or out to the highway. So I think we have to watch out for unintended consequences. So these are the things that the investment team here is looking at. These are the things that we're watching, and I've tried to kind of give you some clues as to things that maybe you should be paying attention to in the future. We stay on top of this. We manage the accounts accordingly, and we take advantage of volatility when we see it, and we try to navigate what is somewhat of a minefield out there, but it's actually a generally positive, upward sloping existence of both the economy and the markets. I hope that I pointed out a few things to you, giving you some things to think about, and let you recognize and understand that we're staying on top of this on your behalf. So thank you very much. I appreciate your attention. Hope this helps. God bless. We'll see you later.